Hello, everyone, it's your buddy Iggy from the Investing Iguana channel. Today, we are tuning into the captivating saga of Singapore's real estate investment trusts, aka REITs, which have recently been dancing to the rhythm of market waves. Now, if you've been a spectator to the financial theatrics unfolding in the heart of our lion city, you'd know that investing in REITs is akin to embarking on an exhilarating roller coaster ride. So, let's dive into the financial corridors and unveil the narrative behind the recent market tremors that stirred the calm waters of Ascendas REIT, Keppel DC REIT, and CapitaLand Integrated Commercial Trust. Ready to ride the waves? Let's jump in. Now, for my eagle-eyed comrades in the investment realm, the recent market flutter was nothing less than a riveting plot twist. Picture this. You're ambling through the bustling financial streets of Singapore when suddenly, you stumble upon Ascendas REIT taking a dramatic nosedive from 2.70 to 2.48 within a mere week, coolly slicing off a neat 8% from its majestic stature. It's like watching a seasoned actor make a scripted exit, circling back to the valleys of late 2022, with echoes of the March 2020 lows haunting the stage. Now, let's shift our spotlight to Keppel DC REIT. Our star here began the week basking in the glory above $2, only to trip and tumble, bowing out at a modest $1.72. The script? A heart-throbbing 14% plunge, all choreographed within a week, with high-volume trading orchestrating the dramatic soundtrack to this market opera. The new price tag nudged it closer to the 2022 lows, and dare we say, even bowing below the March 2020 lows. But wait, the drama unfolds further. CapitaLand Integrated Commercial Trust, CICT, tiptoed into its lowest since the notorious 2020 COVID-19 drama. Yet, amidst the gloom, a 6.2% dividend yield shines through, winking at the hopeful investors. Now, this wasn't just a fleeting rain cloud over a handful of REITs. No, it was a storm that brewed and drenched most of them. Yet, amidst the torrential downpour, a peculiar pattern emerged, akin to a plot twist in a classic drama. The bigger, blue-chip REITs, the high rollers from the prestigious halls of CapitaLand and Mapletree, bore the brunt of the tempest. In stark contrast, the smaller cap REITs, which have been swaying with the bears for a while, seem to have found a little haven this week. So, what sparked this REIT ruckus? The textbook response points fingers at higher long-term interest rates. Cast a glance westward, and you'll witness the U.S. 10-year yield leaping from 3.45% in June 2023 to an eye-popping 4.95% today. That's a bold 1.5% climb in a mere 4-month sprint. The markets were bound to react. It was a matter of when, not if. Yet, the curious cue is, why did the thunderstorm brew this week in particular? Even the 10-year interest rates in Singapore have been marching to a northern tune. But why did the S-REITs bear the brunt so severely this week? Though the crystal ball remains shrouded in mystery, one could venture a guess that the institutional titans decided to offload their S-REIT positions this week. Perhaps the whispers of unrest in the Middle East, coupled with the Federal Reserve's murmurings of interest rates holding their high ground longer, choreographed a rebalancing act or spurred active risk management. The exact script remains veiled, but the tremors were felt hard, especially in the traditionally robust blue-chip REITs, while their smaller cap siblings managed to duck some of the market fury. Now, as the dust begins to settle, a golden question ascends the stage: is this a bargain sale on REITs? Let's run some rough numbers for Ascendas REIT, armed with a 20-year average yield of about 6% and the 20-year average 10-year Singapore Government Securities, SGS, yield at about 2.35%. We get a historic yield spread of 3.65%. Now, let's round that off to 3.5%, just for a touch of generosity. Fast forward to today, and the 10-year SGS yield is holding its ground at 3.4%. Amidst the hum of an inflationary decade, geopolitical tinderboxes, and the higher-for-longer interest rate narrative, a fair 10-year SGS yield might sit at 3%. A simple addition of a 3.5% yield spread hints at a fair value yield for Ascendas REIT at 6.5%. But halt, with current trading yielding 6.3% and a high interest rate seeing potentially casting shadows of negative distribution per unit, DPU, growth of around 3 to 5%, the yield tilts towards a lower 6%. Thus, Ascendas REIT today sings a tune of a low 6% yield, while the fair value chorus hums along at 6.5%. As the financial theater continues to evolve with its complex script, the Singaporean REIT narrative surely stands as one of the intriguing acts. Each market movement is but a note in this grand orchestration, holding cues for the discerning investor to decode and harmonize with. The REIT arena in Singapore is a dynamic ecosystem, offering a medley of opportunities and challenges for the savvy investor. So, as we navigate through the enthralling narrative of S-REITs, let's keep our eyes peeled and ears tuned to the subtle cues that beckon. Now, my fellow investing aficionados, I hope this episode added a new layer to your understanding of the REIT realm. If you found value in today's discourse, don't forget to hit the like button, share this video with your fellow investors, and subscribe to the Investing Iguana channel for more insightful investing sagas. Stay savvy and keep riding the financial waves with poise and precision. Until next time, this is Iggy, signing off.